Most ETF investors do not blow themselves up. They bleed. That is the first truth. They do not usually lose their future in one dramatic trade, one fraudulent stock, or one all-in gamble that becomes a smoking crater overnight. That makes for better stories, but it is not how most damage is actually done. Most damage is quieter than that. It happens through small leaks that look harmless at first, sensible even, respectable even, until enough years pass and the compounding machine is found half empty. That is why I want you to stop thinking about ETF mistakes as obvious disasters. The most dangerous ETF mistakes are silent leaks. They do not usually make you panic. They make you comfortable. They do not arrive screaming. They arrive looking reasonable. That is why they are so expensive. The source you gave me understands this very well underneath the examples and anecdotes. The real logic is not here are 3 beginner errors. The real logic is that an ETF portfolio can look diversified, disciplined, and long-term, while 3 quiet leaks drain more than $100,000 from the eventual outcome. The source names the 3 leaks clearly high expense ratios, emotionally seductive but misleading dividend yield, and financial. Media influence that makes weak ideas feel urgent and intelligent. Phaephilosite Phaeturn 46 File 0 Phay. That is an excellent skeleton. My job is to turn it into the lesson underneath the lesson. And the deeper lesson is simple. Your ETF portfolio is not a bucket of ticker symbols. It is a compounding machine. And if the machine has 3 leaks, then time does not rescue you. Time magnifies the damage. Most people hear that and still do not feel the danger. So let me make it plain. If you lose 1% a year to the wrong fee, you are not merely paying 1%. If you chase a high-yield fund whose price slowly decays, you are not merely collecting income. If you buy what a headline made exciting, you are not merely taking a look. You are feeding leaks, and compounding is merciless with leaks. The reason I care so much about this is that ETFs are supposed to be the place where ordinary investors simplify their lives. You buy a fund, you spread risk, you avoid the drama of stock picking, you let productive assets do the work over a long horizon. Good. In theory, that is exactly the kind of quiet, rational structure I like. But the moment people hear the word ETF, they stop being skeptical enough. They assume the wrapper itself guarantees wisdom. It does not. An ETF is just a container. A beautiful container can still hold poison. That is why you need to inspect the leaks, not just admire the shape of the machine. The first leak is the most boring one, which is why it does so much damage. Fees, expense ratio, management cost, whatever label you want to use, the result is the same. The machine pays the manager before it pays you. And if that payment is too large, the machine can keep running for years while your eventual outcome gets quietly amputated. The source gives the cleanest possible example. $200,000, 15 years, gross return of 10%, one fund charging 1%, another charging 0.05%, no difference in market exposure, no difference in skill from the investor, just fees. The result is brutal. The expensive fund gets you to around $730,000. The low-fee version gets you to around $835,000. Same market, same time, same investor. More than $100,000 gone, not because you were stupid in some spectacular way, but because you allowed a silent leak to stay attached to the machine for long enough. Phaephilosite Phaeturn 46 File 0 Phay. That should offend you. Not emotionally in some abstract anti-Wall Street way, mathematically, because it reveals one of the great crimes of personal finance language. People say it's only 1%, as if annual percentages remain small just because the number looks visually polite. That is childish arithmetic. A fee is not a one-time toll, it is an annual claim on the asset base itself. It comes out of the machine every year, including the years when the machine is finally getting strong enough to matter. It taxes capital, not just gains. It attacks the root, not just the fruit. That is why I call high expense ratios a silent siphon. And once you see them that way, your standards should harden. The source says broad, low cost ETFs often live at very low fee levels, while some flashy or specialized funds drift toward 1% or even 2%. And it notes that the difference matters much more than people imagine. That is exactly right. The beginner sees style, branding, a strong-looking recent chart, maybe a hot theme, maybe some financial media praise, and thinks the wrapper must be worth the extra basis points. But what is actually happening is simpler. More of the machine's future output is being quietly diverted before it ever reaches the owner. Phaephilosite Phaeturn 46 File 0 Phay. This is why I want you to build a different emotional reflex. When you see a higher expense ratio, do not ask first whether the theme is exciting. Ask why the manager deserves a larger private tax on your compounding. That is the right question. Most of the time, the answer is weak. A lot of investors never ask it because fee drag is emotionally unimpressive. There is no siren, no red alert, no daily visible loss that screams at you. The machine still moves, the account still grows, you still feel like an investor. That is what makes a siphon so effective. It steals from your future self while letting your present self stay calm. Calm theft is still theft. I dislike it more than obvious theft because it recruits your own inattention. Now, a low fee alone does not make an ETF good. The source says that too, and it is right. A cheap bad fund is still a bad fund, but a needlessly expensive plain, vanilla exposure is almost always a sign that the investor is admiring packaging instead of protecting the machine. That is why I have always preferred simplicity with low friction over complexity with elegant language. Complexity is often just a place where invisible charges go to hide. Now we move to the second leak. This one is much more emotional. Yield, dividend yield, cash distributions, quarterly little payments hitting the account. This leak is dangerous because it feels like progress. The source is honest about the seduction. Seeing the first dividend payments land creates a real emotional pull. I understand that anyone who likes the idea of ownership likes the feeling that the asset is doing something. Right now, the problem is that many people stop there. They get hypnotized by the payment and stop asking what is happening to the underlying asset producing it. That is where the leak begins. Fay turn 46 file 0 Fay. This is why I want to say something clearly. Income is not the same thing as progress. A fund can pay you generously while making you poorer. That sounds contradictory to beginners, but it is not. A distribution is just cash moving from the asset structure to your hand. If the underlying portfolio is weak, stagnant, overly indebted, interest rate sensitive, or structurally decaying, then the yield can function like a little comfort check mailed to you while the principal slowly rots. You feel paid. You are actually being bled more slowly than a dramatic collapse would bleed you. But the result can still be wealth destruction. The source uses two real examples that make this point brutally well. JNK with a yield around 6.5% and an expense ratio near 0.40%, and Haig with a yield around 5.7% and an expense ratio around 0.50%, to a yield-chasing brain. Those numbers sound attractive, more than attractive, they sound productive, yet the longer-term record in the source is awful in the way that matters. JNK down more than 30% since inception, Haig down roughly 23% over its lifetime. The cash distributions did not change the fact that the machine was not creating real long-term wealth in the way the yield alone implied. Fay turn 46 file 0 Fay, that is the dividend mirage. You look at the water in the glass and ignore the crack in the pitcher. A person can collect $6,500 a year from $100,000 in a high-yield product and still end up with an asset base tens of thousands lower than where he began. That is not an income strategy. That is a psychological sedative. The source says exactly this in substance. The distributions do not compensate for the asset decline. The cash flow feels real enough to flatter the owner, but the machine is not getting stronger. Fay turn 46 file 0 Fay. This is why I want you to stop asking one lazy question. How much does it pay? That is the wrong first question. Ask instead, what kind of engine is making this payment? And is the engine itself becoming stronger or weaker over time? That is the right question. Yield without asset growth is often stagnation in a nice suit. Sometimes worse. Sometimes it is distress wearing makeup. The source puts this well when it says high yields are often a byproduct of underlying assets being under pressure, carrying higher debt, or having less room to grow. That is exactly how the leak works. The yield catches the eye while the fundamental engine weakens. Many newer investors are drawn to the payout and miss what is happening to the vehicle carrying the payout. Fay turn 46 file 0 Fay. This is where adult ETF analysis begins. Not with category labels, not with whatever people on social media say the fund is great for, not with whether the distributions feel nice. Adult analysis asks for total return. Adult analysis asks what happened to the share price over long periods. Adult analysis asks what the underlying assets are actually exposed to. Adult analysis asks whether the yield is the byproduct of durable cash generation or the symptom of a stressed portfolio. That last question matters, especially when people begin buying high-yield bond ETFs or similar products because they think they have discovered safe income. Safe income is one of the most abused phrases in investing. Income is not safe because it is frequent. It is safe only if the asset base producing it is durable enough to survive the regime it lives in. If rates rise, if credit spreads widen, if junk borrowers weaken, the cheerful quarterly distribution can become the prettiest part of a losing proposition. This is why I prefer to think in terms of whether the machine is thickening or thinning. A thickening machine can pay modestly today and become much stronger tomorrow. A thinning machine can pay generously today, while stealing tomorrow from you. That distinction will save you years of confusion. Now, the third leak is the one that feeds the first two media headlines, platforms that monetize your emotions. The source is outstanding here because it stops pretending the informational environment is neutral. It says plainly that many platforms are designed around traffic, which means their incentive is not your outcome. Their incentive is your click, your attention, your arousal, your sense that something urgent or exciting is happening. That is why the ETF world gets wrapped in language like, this fund could triple, or this yield is north of 10% right now, or this famous investor is buying this theme. It is emotional engineering disguised as financial information. Filocyte, turn 46, file 0 Fe, that is the media leak. And the media leak is more dangerous than people think because it does not just sell you bad ideas, it changes the speed at which you evaluate ideas. It pulls your thinking out of the slow lane and throws it into emotional reaction. Excitement first, analysis later. The source says this exactly. A lot of these headlines are engineered to trigger emotion before thought. That should bother you deeply if you care at all about long-term compounding, because compounding thrives on slowness, skepticism, repetition, and disciplined boredom. The media economy thrives on urgency, novelty, conflict, and emotional movement. These two systems are not natural allies. Filocyte, turn 46, file 0 Fe, have always preferred investments that feel like drying paint. That is not because I am dull. It is because wealth built through compounding does not usually announce itself dramatically in the moment. It thickens in the background. The transcript quotes Paul Samuelson saying investing should be more like watching paint dry or grass grow, and that if you want excitement, take a small amount of money to Las Vegas. That is exactly the spirit I want you to absorb here. The machine that builds wealth does not need adrenaline. It needs protection from adrenaline. Filocyte, turn 46, file 0 Fe. This is what most investors refuse to accept. They say they want long-term wealth, but they consume financial media like they want a thriller. You cannot do both cleanly. Or rather, you can, but the thriller usually starts draining the machine. The source gives a telling example. The author bought into a high dividend ETF after reading a headline about yields above 10%, only to discover that the income was real but the share price kept sliding. This is one of the classic ways the media leak expresses itself. It takes the most emotionally attractive attribute, isolates it, intensifies it, and frames it as an opportunity. The investor receives a distilled emotional story, not a balanced machine analysis. Filocyte, turn 46, file 0 Fe. That is why I do not want you using the media carefully. I want you treating it as contaminated by default. That does not mean every platform lies. It means the incentive structure is not naturally aligned with your compounding machine. The source is careful to say that not all financial media is unreliable, and that platforms like Yahoo Finance, CNBC, and MarketWatch can still be useful as inputs. Good, I agree. Inputs, not instruction. Data point, not command. Lead to verify, not thesis to obey. That distinction is where the adult investor parts company with the crowd. Filocyte, turn 46, file 0 Fe, because the crowd reads a headline and asks, what should I buy? The adult asks, what is the underlying claim here? What is the source? What does the raw data say? And does the machine actually improve if I act on this? Those are very different mental habits. Now, let me show you why these three leaks are so powerful together. A high expense ratio already drains the machine quietly. A seductive yield can make you feel rewarded even while the machine weakens. Media excitement can push you toward both the expensive wrapper and the misleading income story before skepticism has time to intervene. That is a brutal combination because it means you can feel smart, paid, and informed at the exact same time you are underperforming badly. That is what makes these silent leaks so dangerous. They do not just reduce returns. They preserve your confidence while they reduce returns. And confidence without evidence is one of the costliest luxuries in investing. This is why I want to give you a much more ruthless way to look at every ETF you consider. Do not ask first whether the theme is attractive. Ask what the machine keeps after fees. Do not ask first what the distribution yield is. Ask what the total return and long-term asset behavior say. Do not ask first who on television or online likes it. Ask whether the thesis survives direct inspection of the fund itself. The source closes with exactly the right trio of checkpoints: expense ratio, dividend yield, and long-term performance. That is good, but I want to sharpen it. Do not look at those as separate little boxes to tick. Look at them as a leak test. Expense ratio tells you whether the machine is being siphoned. Yield tells you whether the machine is paying or just sedating. Long-term performance tells you whether the machine has actually thickened over time or merely looked busy. Fe Philosite Fe Turn 46 File 0 Fe, that is the framework. And once you have the framework, you stop being impressed by the wrapper itself. Because ETF is not a synonym for safe. It is just a transport mechanism. A cheap, broad, durable ETF can be a magnificent thing. A flashy, expensive, high yield, media, hyped ETF can be a perfectly efficient wealth draining machine. Same wrapper, different leak profile. That is what beginners need to understand sooner. Now, I want to say something that may sound severe. If you are still chasing yield because the payments feel good, you are not investing like an owner. You are investing like an employee addicted to the sensation of being paid. That is not the same thing. An owner wants the machine to get stronger. An employee wants the check to arrive. A sophisticated investor knows that there are times when current payout matters. Fine income needs are real. But if you are in the early or middle building years and you let the sensation of quarterly distributions overpower your analysis of the underlying machine, then you are making a childish trade. You are sacrificing structural strength for emotional candy. That is expensive candy. The same is true of media consumption. If your portfolio ideas arrive mainly through headlines designed to excite you, then you are not curating information. You are opening the front door of your machine to professional manipulators. Some of them are not malicious. Some are just paid differently than you are. But the effect is the same. Their incentives pull toward drama. Your future requires calm. If you do not police that border hard, the leak will keep reopening. That is why I prefer direct inspection so much. Go to the fund itself. Read the holdings. Read the methodology. Read the fee table. Look at the long chart. Compare alternatives side by side. Check a second source. Trace the statistic backward until you find what it actually means instead of what the article wanted you to feel. The source explicitly recommends verifying what you read and tracing claims back to origin because many statistics become far more modest or even change meaning once you reach the real source. That is not a small tip. That is a whole philosophy of survival in a media environment that profits from compression and exaggeration. Fe Philosite, Fe Turn 46 File 0 Fe. And once you start doing that, something wonderful happens. The machine gets boring again. That is a sign of health. The best ETF machine should not make you feel like a genius every week. It should make you richer over long periods while giving you fewer reasons to interfere. That is what I want for you. Not excitement, retention, not stimulation, compounding, not the thrill of finding the next thing. The quiet confidence that more of the market as return is staying with you because the leaks are closed. That is the real victory. Let me press one final point. Most investors think their biggest enemy is picking the wrong thing. Often their biggest enemy is picking something close enough to right that they never notice how much it is still costing them. A high-fee ETF can still go up. A high-yield ETF can still pay. A media-loved ETF can still have a respectable year. That is what makes the leak so stealthy. They do not need to look disastrous to be destructive. They only need to underperform a cleaner machine by enough, for long enough. That is how fortunes are quietly separated, not always by brilliance, very often by leakage control. So here is the final test I want you to run. When you look at your ETF portfolio, do you see a machine or just a collection of tickers? If you see only symbols, you are already vulnerable. If you see the machine, then ask three brutal questions. Where is the siphon? Where is the sedation? And who is selling me excitement? If the fee is too high, the siphon is obvious. If the yield is the emotional centerpiece, while total return is weak, the sedation is obvious. If the thesis arrives mostly through urgency and headlines, the seller is obvious. Then your job is simple. Close the leak, protect the machine, and stop mistaking activity for progress. That is how ordinary investors quietly become stronger. Not because they found some exotic edge, because they finally respected how much money can be lost through what looked like nothing. And that is the kind of lesson worth learning early, because by the time a silent leak becomes loud, you usually do not get the lost compounding back.